A higher day on Wednesday with the exception of the wheat market. Sean Hackett Financial Advisors joining us. Sean, let's talk about this grain trade. Corn and soybeans back to the plus side. Was that any more than a dead cat bounce?
I think it's more than a dead cat bounce. I mean, we're actually uptrending in this market. I think every time the market comes down, it sees strong cash. It sees improving bull spreads on the futures market. It sees that the USDA came out and said crops are going to be okay, but not great. We're not really going to build these ending stocks that we need, and so we have to go into this growing season in South America with La Nina hanging on, worrying about what kind of production they're going to have. And as you know, the last 2 years production has been anything but ideal.
That's right. And let's talk about soybeans because you mentioned demand. And when you get a pullback like this, every time we get like November under the $14 mark, it seems like we get good end user buying. Crush margins are good. The bull spreads are working there. So what do you see ahead on that soybean market?
Well, I see the market going higher. Like I said, I really think when we hit that $13 level on the November beans a few weeks back, and then we had that crazy $1.50 move on the weather scare that we had. I just don't think there's enough soybeans. 240, 260, 280 million bushels, whatever the number is for the U.S., that's just not going to make the market comfortable. And as I said, we're not really going to have a good idea of production in South America until January. And you almost always have something to worry about, at least for a little while, during the first year of the growing season. So I'd have to think weather premium needs to be put back on, especially when China will be coming back into the market looking for supply.
Well, let's hope so, because uncertainty about China's economy and what's going on geopolitically has hurt this soybean market here. To start the week, it did.
I mean, we're actually feeling a little more optimistic about demand in China, because when we look at lumber prices, hog prices, copper prices domestically in China, they're all going higher, suggesting that even though we're worried about their economy, it seems like their demand is starting to come back. But obviously, Taiwan could change all of that. If there was an escalation, if they went into Taiwan or even got close to going to Taiwan, and we had some kind of a trade war like 1819, or some kind of a situation where trade was restricted, then all bets would be off. And that's definitely in the back of the mind of the market why we get these days where the market just sells pretty hard, because they're just not sure how to correctly gauge what the probability is of that and what the time frame of that probability would be.
Well, you call it chaos in the entire marketplace, in the entire commodity sector. And what makes that go away, or what helps with that?
I think there's two things for me that we're looking for, Michelle. One is the Fed meeting in September, to have them give a clear statement that they are not interested in tightening anymore. Even if it's just neutral, that they are in a neutral mode, that they believe they've done enough, and they actually might think about lowering rates if the economic data were to weaken. I think that would be signpost number one. The second signpost would be, I know before the second visit to Taiwan by those 5 senators following Pelosi's visit, that there was a meeting that was expected to take place between President Biden and Xi Jinping. And I think that if that meeting actually happens and they have that meeting, even despite everything that's occurred, I think the market would view that as a de-escalation move, that would be a time for both of them to say, look, we've gotten a little carried away. Let's ease down the rhetoric. Let's calm things down. If we got these one or both of those signs in the market, I think this chaos would become a little more orderly at this point.
Yeah. And cotton has been a very chaotic market. Of course, we had the big rally off of the WASDE report and the historically low production cuts. And do you think we've got that all priced in here? I mean, we did have a pretty big down day today.
I think we have. I mean, if you look at the chart of the December contract, we had a left shoulder at 120, a head at 130, and we went almost to the 120 right shoulder. It looks like a classic, head and shoulders top, and when you really think it through, I mean, was it really a surprise that the Texas cotton crop was a disaster? I mean, I don't think so. I mean, I think, I just think the market forgot how bad it was. But when you think about the exports were already on the decline. The physical demand for cotton is already down 20% in many areas that we've already seen that data. And when you chart trading at that 120 level, we're trading at a premium to the cotton price in China, which gives them absolutely positively no incentive to want to bring in higher priced U.S. cotton. And so I really think the market very quickly priced it in, and now it has to determine, have they overpriced it in? If we hurt demand too much, do we need to bring it back down some? So I do think, for the most part, unless there's a hurricane that comes in and wipes out, the deep south cotton crop, which can always happen, I think that part of the weather cycle is over.
So let's move over to the meat sector. Cattle market, the back end of the board keeps scoring new contract highs. Front is getting close. Do we make new contract highs in these front months? Will the funds continue to support this if the cash trade keeps going higher?
I think so. We've talked about this for a while, Michelle, about the shifting from a herd liquidation cycle to a herd rebuilding cycle. I think we are clearly morphing into that. And when those cycles begin, they have a long tail to them and they keep going for a while. And then all the packers that had the advantage before now are chasing and competing with each other to get the few animals that are still wanting to come to the market, as the cattle rancher does what he always does, which is rebuild his herd at a good economic time. So I'm really pretty constructive that this big shift is, especially in the deferred contracts, as you correctly pointed out, that's really where the rubber will meet the road in this part of the cycle. So.
And finally, on the hogs, we have this big discount. What do you think? Does the cash come down to meet, or do they meet in the middle, or where?
I'm constructive. I think the hog market had vertigo yesterday because of this worry over Taiwan and shutting down economic issues. But remember, they had a pretty good run. I would argue that maybe they were just due for some profit taking anyway. But overall, when you see that big discount to cash, I see beef prices are very high. The chicken price is much higher than it should be because of the the bird flu that's been having an issue out there. And so I think that pork prices, that kind of a meat protein, is very competitive in the market. I think demand will stay strong. I don't see this being any more than a knee-jerk reaction to the downside. We'll bounce back.
Okay, Sean Hackett with Hackett Financial Advisors.